Now is an ideal time to be proactive with your tax planning. Decisions made early in the year can materially reduce your taxes, improve your cash flow, and ensure investment, retirement, and estate decisions remain aligned. The following checklist reflects the detailed planning conversations we typically have with Luft Financial clients at the start of the year. Number 1, establish a charitable giving plan. Planning charitable giving intentionally allows generosity to be aligned with tax efficiency, rather than being driven by year-end urgency. Donation tax credits are available at both the federal and provincial levels, with higher credit rates applying once usual donations annually exceed $200. Unused credits may be carried forward for up to 5 years, allowing your donations to be matched with higher income years. So here's an example of a BC resident in the middle tax bracket, donating $10,000. So their approximate combined federal and BC tax credits will be $4,500, approximate after-tax cost of the donation $5,500. Another option is to donate securities in kind. So assuming publicly listed securities worth $10,000 with an original cost of $4,000, that's a $6,000 normal capital gain, $3,000 of which would be taxable, with a capital gains tax estimated at $1,350, leaving only $8,650 available for donation after tax. But if the same stocks are directly donated instead of in kind, no capital gains tax, $10,000 tax receipt, and $4,500 tax credit. So donating securities directly eliminates the capital gains tax and increases the tax efficiency of the gift. For business owners, these charitable donations may be made personally or through the corporation, and corporate donations can sometimes reduce your taxable income, while personal donations can offer greater flexibility depending on your income levels. So this should be coordinated with your capital gains planning, corporate strategies, and estate objectives. Number 2, review your TFSA contribution room. As of January 1st, the annual TFSA limit is $7,000, so somebody who's been eligible since 2009 and may have never contributed has room of up to $109,000. So the actual room varies based on your prior contributions and withdrawals, and generally use your TFSA for long-term growth-oriented investments. Your TFSA strategy should be coordinated with your RSP and non-registered accounts, particularly when managing marginal tax rates and future income needs. Number 3, review your RSP strategy, not just the deadline. The limit for 2025 tax year was $31,560, or 18% of your 2024 income. You can carry forward the unused room indefinitely. So contributions for the 2025 year can be made up until March the 2nd, and you can carry forward those amounts that you contribute indefinitely. Proactive planning allows time to determine not only how much to contribute, but how RSPs fit within your broader retirement planning. This includes coordinating them with your TFSA, your pension, spousal RSPs, and any withdrawal strategies. Sometimes contributing now and deferring the deduction to a higher income year may be very appropriate. Number 4, let's plan your capital gains and losses strategically. Planning ahead lets us proactively manage the capital gains and losses rather than reacting later into the year. This might include reducing some concentrated positions, harvesting your capital losses, or coordinating your gains with deductions such as RSP contributions or charitable donations. If you realize a capital gain in January, you don't have to pay the tax until next year, which is up to a 16-month deferral. This can provide you with tax availability for next year. Number 5, make an RSP contribution. So you can contribute up to $2,500 per child in 2026, generating the maximum CESG of $500 per child. If you miss a year, you can put up to $5,000 per child, generating $1,000 of grants in a single year. Again, align this strategy with their expected education timeline and reduce the risk as post-secondary approaches. Number 6, the FHSA, or first-time home savers. This allows savings towards a first home on a tax-efficient basis. Individuals can contribute up to $8,000 or up to $16,000 if carry-forward rooms available. You deduct the contributions, it grows tax-free, and there's no tax on the withdrawals. Coordinate this with your RSP and TFSAs as part of an integrated home purchase strategy. Number 7, review opportunities to make debt tax deductible. Not all debt's equal in Canada. Interest is generally deductible only when borrowed funds are used to earn income from a business or property. Personal interest, such as on a mortgage or line of credit, is not deductible. But in certain circumstances, we can restructure your household balance sheet so that your non-deductible personal debt is converted into deductible investment debt. This involves selling your non-registered investments, paying down your personal debt, reborrowing the funds, and investing them in income-producing assets. Borrowed funds must be clearly traceable to income-producing investments to maintain the deductibility. Key considerations include capital gains triggered on the sale, mortgage prepayment penalties, cash flow sustainability, interest rate risk, and leverage. Not suitable for everybody, but part could be implemented with a coordinated financial plan. Number 8, let's create eligible pension income. If you're 65 years or older and you don't otherwise have pensionable income, you can create it intentionally. Up to $14,000 can be transferred from an RSP to a RIF, allowing $2,000 of RIF withdrawals to qualify for the federal pension income tax credit. This can produce tax savings of up to $300 a year with additional provincial benefits and could be eligible for income splitting. And number 9, let's review those income splitting opportunities. Family income dynamics often change. Now is a good time to revisit your income splitting strategies like pension income splitting, spousal RSPs, prescribed rate loans, and dividend planning. Proper income splitting can materially reduce a household's overall tax burden. Number 10, revisit your corporate tax. With business owners and incorporated professionals, early year planning unlocks meaningful opportunities. Review your salary versus dividend strategies, your bonus timing, your capital dividend account, and the coordination of corporate and personal charitable donations. Number 11, check your withholding and installment requirements. Changes in your income, investment returns, or asset sales can impact CRA installment requirements, so review those obligations early and avoid interest charges. It'll also support smoother cash flow management throughout the year for you. Number 12, get organized now for the tax season. It's here, and it's time to start organizing your 2025 receipts as the information is received. Your medical expenses, your donations, your investment slips, your business expenses. Create a dedicated 2026 tax folder now to make sure nothing's missed. Number 13, update your estate and beneficiary designations. Life changes, market growth, tax law updates, all these materially affect your estate. Now you can review your beneficiary designations, your successor annuitants, your powers of attorney, and your estate documentation to ensure they remain aligned with your current objectives. And number 14, coordinate everything with your plan. Tax decisions should never be made in isolation. At Luft Financial, tax planning is coordinated with your investments, your retirement income planning, your estate strategies, and your family goals to make sure each decision supports your long-term outcomes. There's a lot of points to go through in one video. Hopefully you found this useful. As always, if you have any questions, reach out to your advisor at Luft Financial. We're happy to help.